In this session, we're going to look at accrued income. Let's start with a couple of simple examples so we understand what accrued income actually looks like in real life. Two common examples are interest earned but not yet received and rent earned but not yet received. And that timing difference is exactly why we need accrued income. Now let's think about which accounts are affected when we have accrued income. Cash flow is only affected when cash is actually received. The profit and loss account works differently. Income appears in the profit and loss when it is earned, not when the cash is received. This is the accruals concept in action. We show accrued income as a current asset on the balance sheet. Accrued income is income earned but not yet invoiced or received in cash. The income belongs to this accounting period. The invoice will be raised later and cash will be received later. Let's now apply this to a practical example. We have rental income for December 2025. The rent relates to December. The invoice is raised in January 2026. The cash is also received in January 2026. The amount is £1,500. So the question we must ask is, which accounting period does this income belong to? This income belongs in December's profit and loss because the rent was earned in December. It doesn't matter that there's no invoice or cash yet. Profit is based on earning, not payment. Now let's record the accounting entries for December. In the profit and loss account, we credit rental income £1,500. On the balance sheet, we debit accrued income. This ensures December's profit is correct. Now let's look at what happens after the income has already been accrued. When the invoice is raised, the business now has a trade receivable. The customer owes us money. At that point, we reverse the accrued income because it is no longer accrued. It has now been invoiced. The entry is debit trade receivables and credit accrued income. This removes the accrued income from the balance sheet and replaces it with a receivable. When the cash is received, the customer pays the amount owed. So we record debit bank and credit trade receivables. This clears the receivable and increases bank. The key thing to remember is, accrued income is reversed when the invoice is raised. Trade receivables exist until cash is received. Bank increases when cash is received. Profit does not change again because the income was already recognized earlier. Now let's look at a slightly more advanced example. We have rental income covering January, February and March. The total value is £900. The invoice and cash both happen in April, so we must spread the income across the 3 months. The income is earned evenly. £900 divided by 3 months gives £300 per month. During January, the business earns £300 of rental income. At this point, no invoice has been issued and no cash has been received. But remember, profit is based on earning, not cash. So in January, the profit and loss account includes £300 income, and on the balance sheet, we show £300 as accrued income. That accrued income represents income we've earned, but not yet been paid for. Now we move into February. The business earns another £300 during February, so again, profit increases by £300. There is still no invoice and no cash. Accrued income now builds up because it hasn't been settled yet. By the end of February, accrued income on the balance sheet is £600, which is £300 from January and £300 from February. Now let's look at March. The business earns the final £300 of income for this contract. Once again, we recognise the income in profit and loss because it has been earned. Accrued income increases again, and by the end of March it totals £900. At this point, the business has earned all of the income. Now we move into April, and this is where everything is settled. In April, 2 things happen. The invoice is raised and the cash is received. All of the income was already recognised earlier when it was earned in January, February and March. So instead of affecting profit, April only affects the balance sheet. When the invoice is raised, the accrued income is no longer needed because the income has now been formally billed. So accrued income is cleared down to zero. When the cash is received, the customer pays what they owe. That means bank increases by £900 and trade receivable is cleared. Let's see the final position after the entire contract has been accounted for and bring the whole accrued income concept together. In the profit and loss account, you can see that rental income of £300 has been recognised in January, February and March. Nothing appears in April because all of the income was already recognised when it was earned. Now look at the accrued income line. You can see how accrued income builds up over time. £300 in January, £600 in February and £900 in March. This shows that the business was earning income each month but had not yet been paid. By April, accrued income is zero because it has now been settled. Let's look at bank and trade receivables. In April, the invoice is issued and the cash is received. Accrued income is cleared, trade receivables are cleared, and bank increases by £900. The key thing to notice is that profit and loss does not change in April. April affects cash and balance sheet accounts, not income. Final takeaway: accrued income exists to make sure income is reported in the correct accounting period. Income is recognised when it is earned. Accrued income appears when income is earned but not yet paid.